This is our Forex blog for April 1st, 2014, and as many of you know, I am converting my automated trading system and our FX Forex signals that our software users use to trade from Visual Basic to C++. It's coming along pretty well considering 2 weeks ago I didn't even understand at all C++ and it looked like Chinese to me. Here's a little sneak peek of it so far. I have the swing levels put in, and keep in mind that I have 15,000 lines of VB Visual Basic code I have to convert. One of the limitations of Visual Basic is when the program gets too big, it won't compile, and I'm pretty much out of luck. I have to either remove other pieces of it or rewrite large parts of it. So I just decided to switch to C++, which is much more powerful. It loads faster. We can go back farther in time, and there's no limitation. If I get to 300,000 lines of code, it will still compile and still run, and it also will be a lot smaller. Thousands of lines of C++ code will only add 5 or 10K to the program size, whereas my old script was almost a meg in size when the Visual Basic was compiled. So one of the new additions that we put in to this is using volume profile bars on a range chart. We got those working perfectly, and there's just an incredible amount of patterns that can be found based on range patterns combined with the volume profile. And what's nice about volume profile is it finds the price most actively traded during any given bar. That's the middle line. Sometimes it's at the lower end of a bar, and other times it's at the high of the bar. And you can also see when price closes above the previous bar's POC or upper value area. It doesn't have to go above the previous bar's high. And so because of that, I'm going to create, and this is the first day I started putting bar patterns in. That's how I start every system. First, find very high probability range bars. Now I'm using the addition of volume and also the volume profile in the patterns, and they're just extremely high probability. These will be used in conjunction with our other methods such as Fibonacci retracements, Fibonacci profit targets. You can see this little fib area from here to here went right to the 1.382 level, and it also happened to be one of my reversal patterns because the value area was at the high of the bar, and that tends to be a high probability trade after a 4 or 5 bar up or down move, because people are stuck in positions right at the end of that bar. So you can have a super tight stop. You're literally risking 3 or 4 pips, and if the trade works like this one did, you can see it pull back 15 pips, and then it continued a little bit farther into the future. But nonetheless, these are pretty quick, high probability trades. You can see this bar right here spent almost all of its time at the bottom of the bar with extremely high volume, higher than the last 10 bars. There is no volume in Forex, but what this is showing is tick volume, which shows how many different price changes there were in that bar. And basically what it tells me is the higher the volume, typically the longer it's spent at that time. This bar started at 753.31 and ended at 820. So it was a tremendous amount of time it spent in that area, and that's what the volume tells me. So typically a 2-bar up, 1 down with a wick like that, it's going to continue down farther. If it spends a lot of time there, and it also closes above the previous 2 bars point of controls, which you can see they're right about the same area, it closed above it. So in the last 2 bars, most people's positions were right around 93. This one closed above it, and normally a 2-bar reversal is going to continue down 1.5 bars before it reverses. So this one didn't, and that's why it was very likely to go up. Plus the trend was up already. Alright, well, that's just a quick update on what I've been working on, and I expect maybe at least another 2 weeks before we release our first draft of the new system, and I'm going to be putting different trade categories in it over time and then improving the accuracy and adding new rules. The first one will be maybe 40 to 60% of what the last one is, but it'll have much higher accuracy based on the new technology we've built in from the ground floor. So In the meantime, what's one of the best ways of trading? Well, in my opinion, and it always has been, just give me the currency indexes and trade the strongest ones versus a week, and trading is very, very easy. This shows you what the dollar is doing, the euro, the pound, the yen, and you can clearly see that the yen's trending down. You can see the daily, weekly, monthly trends down. And basically, when you have a weak currency like the yen, you want to look to, sell it on a pullback. Sell it on a pullback. Or if you're a scalper, you can short sell each one of these little tiny up moves, and if they don't pan out, a lot of times you have 4 or 5 pip loss or break even, and sometimes you even make 4 or 5 pips when they don't work out. And when the trends do, continue, you have very big profits because you're trading in the weakest ones. And so the yen's weak, and you can see the pound's also weak. If you trade the pound versus the yen, it's going to be pretty choppy. They're both weak. You don't want to buy or sell two weak ones, or buy or sell two strong ones. What's the pound yen? Let's just give you an idea of when both currencies are weak, it tends to be pretty choppy. And you can see, the pound was weaker than the yen at times, and other times, the pound was going up when the yen was going down. That's what, gives you these trends. But most of the time, when you have two currencies are both weak, you have just a bunch of crap like this, up, down, up, down, up, down, no trend. You can see after 9 o'clock, the yen is underneath its previous day's low. It's just broken down, and you can see after 8, the pound's starting to get stronger and returning back to the hourly moving average. The containment bands usually contain price, and when price hits these, oftentimes it will reverse back and touch the hourly and then continue. So you can see the pound worked its way down, came up and hit the hourly, came down, made a 50% fib pullback here, and it wasn't able to go underneath that, and the downtrend's pretty much likely to be over at that point. Let's just keep this simple. The euro is one of the strongest ones here, and you can see it went from underneath above its hourly moving average, above its 15-minute moving average. The yellow line is VWAP. It's where most traders have positions in all the euro pairs. So it's a very key breakout right here at 3 o'clock. At 3 o'clock, the weakest one is pretty much the yen. So you'd want to buy the strong euro versus the weak yen. It's that simple. Bring up a euro-yen chart, and you can use any time frame that you want, but basically you're looking for buys. And there's really only two methods. One is, kind of a sideways, either rectangle pattern or wedge pattern like this breakout. Here you have a little rectangle flag pattern here. But, some of the higher probability trades are kind of pullback trades, and you'd get in when it breaks the trend line and your stops right underneath the low. And it really took it a while before it really exploded up. But if you took this first trade, this is your risk, and you can see it went up and went sideways. You probably would get out at the next wave somewhere in here, and you made 5 to 8 times more on that trade than what the risk was. This one kind of went up here and double topped. You might have exited half. Your stop got hit in the second half. You might have made this much on the whole thing. So 1.5 times more profit than what your risk is, and that's the key to trading. Super low risk. And when the trades work, your profits are higher. In this case, it came up to the highs and broke through it. So you move your stop up, you move your stop up. At that point, you want to draw your fibs on there, and usually between the first and second fib target's a good place to get out. So in this case, you're never going to. A lot of times, I'll exit half my trade at the first fib target, half at the second one. So your profit on this one would be somewhere in the middle, and you can see it's 4 times bigger profit than what your risk is. And that's the key to trading. Sometimes you're only going to get even a fraction of what your risk is. You risk $100, for example, and you only made 50. Other times you risk $100, you make 300 or 400. But that's what makes trading such a fun thing to do and profitable once you learn to do it, especially when you focus on the strongest currencies. Let's take a look at one more example for you in today's blog. You can see the New Zealand was kind of going sideways, broke above yesterday's high, came back into it. It's going sideways, broke down underneath the point of control around 10 o'clock. Pretty high probability one to be looking for sells. You can see the Swiss is strong, so you could sell the New Zealand Swiss after 10. Now, the only downside with this is the longer term trend, weekly and monthly, is up. So it's not as likely to fall off a cliff like this. It did, but it's much less likely for this to happen. So this is going to show you a big profit here, but most of the time when you trade a currency like that one that's longer term trends up, you're not going to find such big counter trend moves. I forget the exact time the New Zealand got weak. I think it broke underneath its hourly at 7 and broke underneath the point of control at 10. So anywhere from 7 to 10 you really have a pretty high probability confirmed downtrend. At 7 it's already gone down too much, so you wait for a pullback. Here's some of the examples of trades that you would take, and again the small risk, and even if you're a scalper, you pretty much made what your risk is on that one. A little bit more on this one, small amount, and you can see this one just kind of went down and sideways. If you got out of that trade right here, most of the wins are bigger than the losses. And again, the New Zealand, the longer term trend is up, so it's not the highest probability to sell it, and that's why you have much smaller losses. Much smaller profits. You can see the Swiss is strong. We know that the yen was weak today, so I'll show one more example. Buy the Swiss yen. Strong Swiss, weak yen. You're going to have very high probability trades, and you can see pretty much in every little pullback this thing went up. This exploded up. Here's really your first trade after the first move that was confirmed up. Small risk, small profit. Next pullback, small risk, much bigger profit. And once these things go up I'd say 3 to 5 waves, you want to really start being careful. And then at that point, if you're trading one that's the longer term trends down, you can draw your fibs off the last swing and sell it at the fib target. If you move this over to the last swing here, you'll see that it ran into some trouble at these fib targets. Very high probability places to exit your trade. And when you use fib targets, you can increase your profitability on the trade. Instead of getting into a trade and letting your, let's say, trailing stop get you out, you can oftentimes maximize your profit and make a few more pips, 5 to 15 in some cases. So you can see in this case, get in here, get out right here at the fib target, you made 4.5 to 5 times more profit than what your risk is. So with those kind of win versus loss ratios, you don't even have to be right 50%. You don't even have to be right 40% if you can find super strong currencies and trade them like this. And then also keep in mind that this is your initial risk. Once the trade kind of goes your way, you move your stop in half. As soon as it goes up a little bit more, you move your stop to break even. And so a lot of your trades, even though you might initially be risking 6 to 12 pips, your ultimate loss if the trade doesn't work is going to be half that, or even less than that. And a lot of times you have a 3 or 4 pip win when the trade really doesn't work out, versus a loss by moving your stop up. That's what happens when you trade the strongest currencies versus the weakest and using our currency indexes.